Everybody, it's Brian Shannon from alphatrends.net. Today's Friday, the 22nd of March, 2019. We had a kind of mixed market here, a difficult market in terms of volatility, and some real red flags here on these weekly numbers. The Russell 2000 lost 3.3%. The Biotechs lost 5.25%, and the financials down close to 5% this week. So, and volatility way up. So let's take a look at the charts and make some sense of it. The daily chart for the S&P 500, we saw that this widely watched 280 level was taken out on the upside, and it looked like it was going to, well, it was kind of tricky, as I said, because first we had the Federal Reserve on Wednesday, and the market rallied off of that and then failed at the end of that day. And on Thursday, we really squeezed shorts, and then today it came back down and trapped buyers. So we're back below that 280 level. That's not a good thing to see. For the week, again, we're down a little bit in the S&P 500, but more importantly, we broke out and then we failed to hold those gains. That puts us on high caution, basically. We're below, or we closed right below the advancing 20-day moving average, and it looks as though this market has the possibility of, from a failed breakout, could come a fast move lower. We definitely saw, big volume in here today, and we have a lot of volatility recently. And as George Soros says, the volatility tends to peak at turning points, and certainly it traps some buyers over the last couple weeks as it broke above that 280 level, and now we are below a declining 5-day moving average. So I'm going to continue to treat this market the way I always do. When we're below a declining 5-day moving average, I look for rallies to fail, and then if it reverses back up, the buyers take back control, well, that's great. Then that gives me a long bias. But for next week, I think we have to be very cautious in here. As long as we remain below about 282 for the first couple days of the week, then it seems likely we will continue to sell off here, so be careful. The NASDAQ, let's frame this with the daily chart. It's had a phenomenal run from 144 on December 24th and up to 183-ish. Now, it's gotten extended. Look at where we just came from. We just came from 170 up to 183. So some pullback is a normal thing. We broke below the 5-day moving average today. That 5-day moving average will begin to flatten out on Monday, and I think that a likely scenario for the NASDAQ is something if like this, if not more aggressive to the downside. What would change my mind is if it was to get back above and hold above 181. I was on Yahoo Finance on Thursday talking about Amazon and the fact that you didn't want to chase the stock after a breakout like we've seen. In fact, I had sketched it and they used that. I'll put it on this post with Alpha Trends that we want to see it do something like this. Yes, the stock broke out, great, but we didn't want to chase it. We want to see it pull back. And the same is true for any stock that's run a significant distance before you decide to buy it. The Russell 2000 is right down on the year-to-date volume-weighted average price. It's the only market that's really undercut that 50-day moving average significantly. That is benchmark average, not sector. And it's possible that if that fails to hold, then I think that the next level of significance will be down here at about 147. That 147 is the approximate volume-weighted average price from the December 24th low. So, some further shakeout down into that area might, and what we might actually do is to see this market rally a little bit and then come back down. But really strong selling in there today as this market confirmed it was in trouble by making a lower low below a declining 5-day moving average. So stay away from the Russell 2000 for sure. Well, let's see if that 50-day moving average or 20-day now turns into resistance and perhaps is the beginning of something bigger. The semiconductors had a week here that did see some gains, up 0.5 percentage point. But when we go back and look at what happened, it was very volatile, and you can see they lost a significant portion of those gains today. Let's actually look at the weekly chart just to show you how close it's come to really all-time highs here after a significant bounce from those December lows. On a 65-minute chart, 65 minutes because we have 6 equal candles per day. I think that you want to look at the volume-weighted average price from this most significant recent low, and I didn't draw that in properly, so let's take a look at it here like this. We're coming down towards that level, so I think 105.5-ish next week. If it can bounce or hold in there for a little while, that's good. But it tells me also that, given the magnitude of this rally, how far and how fast we came in the advanced volatility we're seeing up here, I would expect that it probably does something like this, then maybe holds near this 105.5, 106 level, and then perhaps continues to see some selling. Biotech's got hit, and that was in large part due to Biogen IDIC, BIIB. This stock lost significant ground, and this is a blue chip in this group. Biogen IDIC has been around for a while. I don't even know if they call it Biogen IDIC anymore. But anyways, Biogen's been around for a while. You can see we're now at levels not seen since 2013. So it's not just the little biotech stocks that can have significant risks here. This stock lost a huge amount this week, and that, of course, affected the biotech index. Now, on the biotech index, what we have here is we do have a lower high, and now we have this little band of support in here. If that breaks, I certainly wouldn't want to sell short there. To me, that would be most likely a trap. Instead, we would want to see it come down, rally up, because you have to think, where does it come from? It just dropped from 115 down to 108. It just dropped 6.5% in a short period of time. So people with stops under here, let them get stopped out. But shorting it, I would wait for a bounce and then look to sell the next wave lower as it begins lower, similar to something like this, as it breaks the momentum. So not after a significant move. That's one of the biggest mistakes people make. Now, it doesn't mean you might not be able to make some money shorting below there. Maybe it goes down to 104, but you have to look at it from a risk-reward standpoint. I'd rather see it come down like this, and let's just take a look here. I haven't looked at this yet. The VWAP from the December low, we're right, pretty close to that. So break down below that slightly, rally up, and then the next leg, more significant leg lower, I think, is more likely to begin at that point. Financial stocks really got hit hard this week. Let's take a look at the weekly chart. On the weekly chart, we have that declining 200-day moving average, which we failed from, and we're back below the 10, 20, 30, 40-week moving average. It made a lower low, but again, it's more likely in my mind to bounce from this level. The VWAP off the December 24th low, we undercut. So, no significant support being found yet. You can look at things such as Fibonacci and say maybe it's going to retrace 38.2%. I didn't even know that, but here we are right on 38.2%. So I certainly wouldn't be selling at this point or selling short. Maybe it continues a little bit lower. I didn't mean to add a note. But maybe it continues a little bit lower. What I'd rather see is kind of what I was saying about the other markets. And for some reason, there we go. I'd rather see it bounce a little bit, maybe up towards 26 over the course of next week, and then short it as it begins to fail, if it begins to fail. Let's take a look at Apple. Apple had, got up to and through that 200-day moving average. It's had a great run. Right now, we've got the 20-day moving average down in the same spot as the VWAP from the all-time high, near about 180. I don't think it's unreasonable to think it might come down to there. As far as a risk at this point, if we take a look at two key VWAPs, here we have the volume weighted average price since the earnings. We opened below that 2 weeks ago, but then ramped higher quickly. So now what we want to do is we want to add a volume weighted average price from this event right here. So from that low, and that gets us to about 186. I would think that we're likely to come down fairly quickly to 186, maybe put in a lower high and then down towards that 180. It is still in an uptrend, so keep that in mind. But considering how far it's come over the last several weeks or months rather, and looking at it from a Fibonacci perspective, we came very close to a 61.8% retracement of the peak here to this low, very close in there. So some normal profit taking down to 186, bounce, and then go back down to 180-ish. I think is something you can look at. I'll tell you something else that struck me this week is just how much attention this foolish IPO from Levi Strauss got. The stock priced at $17 per share. The volume weighted average price since it began publicly trading is $22.61. That means on average, all the people who bought it in the aftermarket, or well, on average, all the people in the aftermarket are losing money. The people who are making money here are the people at Levi Strauss and the big mutual funds and hedge funds that get allocated the IPO. Chasing an IPO that's up from a pricing of $17 a share. It was first, I think, expected to price between 12 and 14. They bumped that to 17. It opened at 22 or whatever it is. I would expect that it's most likely Levi's goes down to test at least the $17 level, and then more likely probably continues down to that $12 to $14 original range that was in. I'd say stay away from a stock like this, especially while it's below the volume weighted average price from the IPO.